The silent gold rush. Why central banks are buying like never before is a big question. Imagine a silent global arms race. But instead of weapons, the world's most powerful financial institutions are stockpiling a single, ancient asset. An asset that has been the bedrock of money for millennia. They're buying it at a pace and scale not seen in generations. Welcome, everyone. Today, we're pulling back the curtain on one of the most significant and underreported financial stories of our time. The massive, coordinated gold-buying spree by the world's central banks. We'll journey from the gold standard to today, uncover the stunning statistics, decode the geopolitical strategies at play, and discuss what this means for your money. This isn't just history. It's the future of global finance unfolding right now. Let's dive in. Here is a brief history of gold, the sun that finance orbited. To understand why this is such a big deal, we need a quick history lesson. For centuries, gold was money. The pinnacle of this was the classical gold standard of the late 19th and early 20th centuries. Currencies were directly convertible into a fixed quantity of gold. It created incredible international stability, but was also rigid. Then, in 1944, the world created a new system at Bretton Woods. The US dollar became the world's reserve currency, but it was itself backed by gold at $35 an ounce. Other currencies pegged to the dollar. The dollar was, as famously said, as good as gold. But that ended in 1971. President Nixon temporarily suspended the dollar's convertibility into gold. It was never reinstated. We entered the era of fiat money, the currency that has value only because a government says it does. For decades, gold was seen as a relic, a barbarous relic as Keynes called it. Central banks, especially in the West, started selling their gold reserves. But the story doesn't end there. The relic is back, and it's stronger than ever. Fast forward to the last 15 years. The trend of selling has not just stopped, it has violently reversed. Look at these numbers. In 2022, central banks bought a staggering 1,136 tons of gold. It was the highest level of demand on record since 1950. In 2023, they did it again, adding another 1,037 tons to their vaults. In 2024, the trend continued, adding another 1,092 tons. In 2025, the demand remained strong, although there was a 21% decline with 863 tons added to the vaults when compared to the previous years. The decline in 2025 is attributed to the record-high gold prices, which prompted a more cautious approach from some buyers. Despite the slowdown, demand of 863 tons is still well above the pre-2022 decade average, underscoring gold's enduring strategic appeal. A significant feature of the market is unreported buying. In 2025, as estimated, 57% of total central bank demand was not immediately disclosed through official channels, indicating that the actual accumulation may be higher than reported figures suggest. This isn't a one-off event. This is a structural multi-year shift. So, what changed? The catalyst was a single seismic geopolitical event. When Russia invaded Ukraine, the West responded with unprecedented financial sanctions, including freezing approximately $300 billion of Russia's central bank foreign exchange reserves. This was a wake-up call heard in every finance ministry on Earth, particularly those not aligned with the West. The message was clear. If our foreign reserves, primarily held in US dollars and euros, can be frozen or weaponized, they are not a safe asset. This event crystallized three powerful motives driving central banks today. Number one, de-dollarization and diversification. Countries are actively seeking to reduce their dependence on the US dollar. They don't want all their eggs in one basket, especially a basket that can be taken away. Gold is the perfect alternative. It's neutral, apolitical, and nobody's liability. Central banks, particularly in emerging markets, are seeking to reduce over-reliance on the US dollar in their foreign exchange reserves. This de-dollarization aims to mitigate risks related to US policy, fiscal sustainability, and currency volatility. China increased its gold reserves while reducing its US dollar allocation. Gold has overtaken the euro to become the second largest global reserve asset by market value. Number 2. A safe haven from geopolitical risk. In a world increasingly fractured into competing blocs, gold is the ultimate safe haven. It doesn't carry counterparty risk. You can't sanction it. For nations like China, Russia, Iran, and even neutral countries like Singapore and Turkey, this is paramount. Sanctions on Russia's foreign reserves in 2022 highlighted the risk that foreign currency assets, like US treasuries, could be frozen. Gold, as a physical asset, is immune to such actions and offers political neutrality. Number 3. A hedge against domestic instability. For some countries, gold is a hedge against their own economic challenges. In nations with high inflation or weak currencies, holding gold helps stabilize the value of their national reserves. For centuries, gold has been trusted as a long-term store of value, not because of hype, but because it preserves the purchasing power when fiat currencies weaken or inflation rises. As major economies pile up record-high debt and massive deficits, those fears are no longer theoretical. They are very real, and they are driving renewed interest in gold. Number 4. Strategic reserve characteristics. You might be wondering why it matters. Gold is a tangible asset with no counterparty risk. It does not rely on promises, institutions, or trust in another party. Holding gold strengthens a nation's financial credibility and acts as a powerful portfolio diversifier, since its price often moves independently from stocks, bonds, and currencies. This structural advantage helps explain why gold prices stayed resilient from 2022 to 2025, even as interest rates surged, something that would normally push gold price lower. Historically, that should not have happened. There is a growing element of groupthink or herd behavior at play. As more central banks add gold to their reserves, others feel pressure to follow because no one wants to be the last one without it. So who are the key buyers? It's crucial to see who is buying. The leaders are. The PBOC in China has been a consistent, opaque buyer, likely seeing gold as a key pillar in challenging dollar hegemony. Poland and other Eastern European NATO members are buying for national security reasons, a lesson perhaps from seeing Russia's reserves frozen. Singapore, Qatar, India are major financial hubs and growing economies diversifying their assets. It is a truly global phenomenon. What does this mean for you, the individual investor? Here's how to think about it. Number 1. See the signal. Don't chase the noise. Central bank buying is a powerful, long-term fundamental driver. It creates a solid floor under the gold price. This isn't speculative day trading, it's strategic, structural demand that could last for years. It makes a strong case for having a strategic, long-term allocation to gold, not for trying to trade around daily prices. Number 2, your why determines your how. If your goal is to emulate the central banks, that is to own a safe, neutral assets which cannot be confiscated for the long term, then physical gold in the form of bullion or coins is the purest play. For ease and liquidity, gold ETFs like GLD, IAU are excellent, as each share is backed by physical metal. Remember, gold mining stocks, GDX, GDXJ, are a different bet on corporate profitability, not just the metal's price. Number 3, allocate, don't speculate. The classic role of gold in a portfolio is as a diversifier. A 5 to 10% allocation can act as a powerful hedge against systemic risk, currency devaluation, and the exact kind of geopolitical turmoil that is driving central banks to buy. Don't go all in. Use it to balance your portfolio. Here's a fascinating fact to tie this all together. For much of the 20th century, gold flowed westward, to the vaults of the New York Fed and the Bank of England to back the financial system. Today, the flow has decisively reversed. Gold is moving eastward and into the vaults of nations that are rising economic and geopolitical powers. This isn't just a trend, it's a symbolic transfer of financial power. In summary, the central bank gold rush is more than a market statistic. It is a loud and clear signal about the future of the global financial system. It tells us that the era of unquestioned dollar dominance is over, and that we are moving towards a more fragmented, multipolar world, where gold will reclaim its historical role as the only truly universal form of money. For an investor, ignoring this signal is like ignoring the tectonic plates shifting beneath your feet. It's not about predicting the next $100 move. It's about understanding a fundamental change in the financial landscape. What are your thoughts on de-dollarization? Is gold a core part of your portfolio? Let's have a conversation in the comments below. If you found this research valuable, please hit the like button and subscribe for more deep dive analysis. It really helps the channel. Thanks for watching, and until next time, invest wisely. We are not a licensed financial advisor. The information in this video is for educational purposes only and should not be considered financial advice. Always do your own due diligence and consult a qualified financial advisor before making investment decisions.